Hello, everyone, and this is our podcast that we're going to do on the trade world war that we are in right now. And we wanted to go over with you what has happened in the past with previous times when the United States has raised tariffs, and what did the market do, since that's what we're all concerned about, and what does that mean for what's going on right now with the current increase in tariffs that President Trump has enacted and that are about to be enacted on the 9th. So we have a lot to cover. Before we get going, just to refresh you, I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And we're a firm that we specialize in working with people who are over 50, who are retired or retiring soon. And our singular goal is to create as many SCWPers as we possibly can. And a SCWPer is a client of ours who has retired. And SCWPers is the acronym for Second Childhood Without Parental Supervision. So we want our clients to go and play and have fun. Let us get the gray hair for them, even in times like right now where the market is falling and we got all this stuff going on. We want our clients, we want you to have financial peace of mind. And so we want to go over what's going on. For those of you who are not aware, we have gone defensive with our clients last week. So we're telling you now, we tell you after our clients because they pay us in deference to them. But we are defensively positioned right now. We've gone very defensive because of the prospects that this could have that we'll go into here with you. So I want to bring into the conversation Jordan Roach, our Chief Investment Officer. Jordan, good to see you again. Feels like we're doing these videos and these podcasts every day now, right? With all this stuff that's going on.
Plenty of things to think through, that's for sure. Yeah.
So let's go back in time and let's talk about, tariffs. And so over the last 70 years, this is actually the fourth time that the United States has raised tariffs on foreign countries. So let's go back to the first one in the last 70 years, which was 1955, and tell us a little bit about what happened there.
I mean, in 55, so that's where we started seeing rates, your average tariff rates go up. I think by then, the average tariff we levied was about 5.9%, and then it went to mid sevens. And it didn't happen necessarily overnight, but it was almost a 2% absolute increase over that time period. And markets had to digest. And what you found is, over that 7-year period, I think markets corrected, meaning about a 10% correction about 4 times. So they were trying to deal with it like the market is today. And the worst ultimate sell-off was about a 28%er.
28%. Now, of course, tariffs weren't the only thing that was going on in 81, 82, right? They had high inflation and all that. But the tariffs, and we have inflation today too, right? Not as high as back then anymore. But yeah, inflation was a factor. The Fed was in play.
Korean War, Vietnam was kind of, we had all sorts of dynamics at play, as always. Yeah. It's never one thing only.
Yeah, and so that was would you say that was a 28%? 28%
in
the S&P.
Yes.
Okay, and so not pleasant and a bad bear market.
Yes.
All right, and so let's go forward to 1980 through 1983. So this was Richard Nixon, right? So this was I
was actually 83 would be what, Carter to Reagan?
Oh, that's right. You're right. That's right. Richard Nixon was before that.
He was in that first one we talked about, actually.
You're right.
Really, yeah.
So 1980, 83, we had that was Ronald Reagan, and we had increase in tariffs then too.
We had now average tariffs by then actually fallen relative to that 50s period. So instead of 5.6 to 7s, we're talking about now they're down to about 3 leading into this period, and they moved from about 3.1 to 3.7% over a 3-year span. And again, markets rhyme sometimes. 27% of that time.
27. And this was a 0.6% increase in tariffs.
That's right.
Over 3 years.
For 3 years.
Resulting in a 27% bear market.
27%.
And the one in 1955 was a 1.7% increase in tariffs.
Right.
And that resulted in a 28% bear market.
That's right.
Okay.
Just a nudge in that direction. Market's
Okay.
big nudge.
All right.
The other side.
So let's go to Trump version 1, 2017, 2019. Yep. What happened there?
Went from about 1.4, 1.5 to, I think, 2.5, 2.7 in that span. Mm-hmm. So, again, that started mostly against us in China, and markets fell that time just under 20%. 19. I was a 19%.
19%er. So in the 3 times, so we had a 1.7% increase in tariffs, and that resulted in a 28% bear market. We had a 0.6% increase in tariffs, and that resulted in a 27% bear market.
Yes.
And then we had a 1.4% increase in tariffs, and that resulted in a 19%.
Right.
So what's going on right now?
Bigger
We're going
and a faster sell-off to start.
We're
That's
going
right,
from 3 to, what does he have?
Minimum is 10, I think, right?
Right now he's got 22% on the
Over
table.
on average, yeah, that's right. That's right. So that's a much bigger increase than we've seen in past cycles.
It's a multiple of 7.
Right. That's right. So I don't know if we can extrapolate that on markets.
So if the others were 28%ers, this would be 7 times worse. So this is what is that? 150% drop in the market. We're going to go below 0.
That's right. That's right. That's right. That's right. Fortunately, that's not can't happen, but that's right.
Yeah, I mean it's not funny. I'm laughing, but it's not funny.
Yes.
I mean if we have a terrible so one of the things that we looked at was in terms of our sales strategy is we also look at what the yield curve is telling us, right?
Right.
And tell us about the yield curve and what it's telling us right now.
So the yield curve, which is relationship between, for us, there's different yield curves, but we look at really the relationship between 3-month Treasury bills and then about 10-year Treasury bonds, and to see what's the difference in spread paying. And what we're seeing is right now, long-term bonds are paying less than short-term. And historically, when the market starts doing that, and it's first started saying this October of 2022, a long time, even before this, and it still holds today, is that yield curve is inverted, meaning the bond market right now, along with the stock market, but the bond market actually led in this perspective, is saying maybe trouble ahead.
Okay, so it looks like the yield curve, when it inverts, has predicted every recession we've ever had in the last 100 years, right?
Has not missed one.
It's 100%. Now, it does predict recessions that don't happen, so it's not 100% accurate. But in terms of predicting the recessions that did happen, it is 100% accurate.
Right.
And right now you said it's inverted.
It's inverted.
So right now the yield curve of the bond market is saying that recession's coming.
That's right.
And the thing about the bond market is that's basically people lending money, right? Mm-hmm. When people are lending money, they're way more rational than the stock market, in my opinion, because that's kind of an emotional thing. I think it's going to go up. I think it's not. I'm greedy. I'm scared. I'm happy. Whatever it may be. But the bond market, it's about interest rates. It's about mortgages. It's about credit cards. It's about those kind of things, and it's the Fed doing the interest rates. So it's a much more serious, sober market.
Oh yes.
Than the stock market. So pairing the two together can help to give a more context and maybe a clearer picture.
Absolutely. Yes, I think that's right. You got to pair the two because they do act differently. You have one that's more looked at as guaranteed. So if you see rates moving on the bond side, Treasuries yield, that's a bigger scare because you're guaranteed, subject to the U.S. government just going defunct, getting your money back. With stocks, you certainly are not, which is probably why it's more emotional in there. But you pair those two together, give you a bigger picture of what's going on.
And that's why we went defensive.
A
big part of that was not only did our strategy say it was time to sell, but so did the yield curve.
The yield curve was a confirmer. Coming. That's right.
Yeah. That's exactly right. And so, ladies and gentlemen, I guess my question to you would be, what are you doing right now? Because, we work with people who are over 50, who are retiring soon. Specifically, I'd say within 5 years of retirement or the first 5 years of their retirement. So that decade, we consider it to be the single most important financial decade of your entire life. Because if you experience large losses during that decade, it could cause you not to be able to retire when you want to. It could cause you to not be able to enjoy the lifestyle you want in your retirement, or maybe you want to go back to work, but you can't because your job's been replaced. So during that decade, we think it's very important. And right now, hopefully this works out and everything turns out to be okay. But in our view, we always plan for the worst and hope for the best. We always plan, our strategy is designed, what we say is we want to have a tolerable downside. Our strategy is not perfect. You have to lose some money before, it's kind of like you have to wait to see the whites of their eyes before you shoot. So there is that. But it is designed to have a tolerable downside and to protect our clients' retirement. And so Normally, I don't give the hard sell, but given the circumstances right now, I would encourage you to go to our website and click on Meet with an Advisor and visit with one of our retirement planners. They'll talk with you about our Invest and Protect strategy and why and what we have done, and maybe it's a fit for you. And we'd love to meet you and hopefully one day make you a SCWPS as well. So right now, it's a tense time, and even if we settle at the 10%, which I think is probably Trump's end game, right? To settle at about 10% that seems to be what looks like it. That's still from 3 to 10. That's
very meaningful.
That's a tripling of what's happening, and that could cause a global recession and retaliatory measures from others, and could put us into a pretty severe recession. And there's a precedent for that with Ronald Reagan, right? He put us into a very severe recession to get inflation and the stuff that he was concerned about.
Absolutely.
So pain can come.
Absolutely could. I mean, parts 1980, 81, 82, 83, I mean, all of it, very volatile.
Yeah.
And sometimes willing to do that to kind of reset things internationally and domestically.
Yeah. And President Trump has even said we're going to have some pain here before we get to the other side. And so taking measures to lessen that pain might be a good idea.
Absolutely.
So ladies and gentlemen, thank you for watching and listening to our podcast. I hope you got some information on it that is valuable to you. And as usual, I hope this video found you healthy, wealthy, and wise. And we'll talk soon. Hello, everyone, and thank you for watching our Market Alert video. It occurred to us with all the stuff that's happening and how quickly it happens that we need to create more content for you more frequently. And so, case in point, we have a podcast for you that we made with regard to how tariffs work and how businesses and countries may react to that, and more importantly, how your investments and consumers, which drive our economy, may react to it as well. So, click on the link in the description so you can watch that. And thank you for watching our podcast.
Retirement Planners of America,